So you're wondering, how is a venture capital or a private equity fund actually even structured? Either you want to be a VC or you're an entrepreneur and you need to know how these things are structured so you've got good alignment. Maybe you aren't sure where to look for answers, and so you turn to YouTube, and YouTube has brought you to me. Well, you're in luck, because as a VC myself, I know the structure like the back of my hand. And not only that, I've explained it and taught hundreds of people at this point on what the structure is, how all the pieces fit together, and why it matters. So let's get started on structure. There are three basic entities within every venture fund that you have to be aware of. There's the management company, there's the limited partnership, and there's the general partnership. The fund that actually makes the investments, that's actually called a limited partnership. And it's composed of a bunch of limited partners, which are your investors. So when you go out and as a venture capitalist and you convince somebody to invest in your fund, what you're doing is you're asking that person to make a commitment to your fund and become a limited partner. Now, the reason they're called a limited partner is because they're limited in two ways. One, they're limited in terms of the amount of control they have over decision-making around what investments that you will or won't make. And two, it also limits their liability. So if you end up making an investment in something like totally off the reservation and it goes south, right, they can say, hey, I didn't have any control over that, so their liability is limited. The next entity is called the general partnership. And the general partnership acts as the manager of the fund. And so it decides where does the money go once it's all been collected into the limited partnership. And then the last one is the management company. Now, the management company is the actual brand of the fund. So when you think of like Sequoia or Excel or one of these many venture funds that are out there, you're probably thinking of the actual management company. The way the management company operates is it's the operations of the fund. So it's the entity that hires and pays salaries. It takes care of like office space and overhead. It runs the general day-to-day operations of the organization. How do VCs make money? Well, you basically have two tiers of venture capitalists. You have the support staff, which could be executive assistants, it could be analysts, CFOs, other administrators, right, within the fund. And then you have what are called general partners or partners in the fund. And the general partners and the admin get paid salaries through the management company typically, but the general partners also get paid something which is called carry. Now the carry is basically the profits, or it's like a bonus on your performance as a venture capitalist. And the way carry works, and we'll talk about this in other videos in more depth, but basically you get, as a general partner, a percentage of the profits of the companies that you invest in. So for example, if I, as a VC, invest $100 million, my fund is $100 million in size, and I invest that and I turn it into $300 million, then like the pretty typical standard is I will get 20% of the profits. So $300 million return, I got to return the $100 million that I invested, and that leaves me with $200 million of profits. I'm going to get 20% or $40 million of that as a bonus for making really good investments and generating great returns for my investors. That's called carry, and that flows to the general partners who are making the investment decisions. Those investments can take like 10 years to pay off. And that's even though $20 million is like a big, or $40 million is a big payday, you got to wait like 10 years to make that money. So how do you run operations today? Well, the way you do that is through what's called management fees. Now, management fees are typically paid on the total assets of the fund or the total assets that have been invested from the fund. And they usually are about 2% annually. So let's say you have a $100 million fund. Well, every year for your investment horizon, you're going to get paid 2%. So $2 million. And that $2 million has to cover all of your overhead. So it's got to cover all the salaries, the travel, the office space, any other kind of diligence related items. All of that gets covered with that $2 million for operating expenses. Now, here's the thing about management fee. It's not like really a free ride because you have to pay it all back before you get paid your bonus as a general partner. So that's the basic structure. So you've got your limited partnership. That's where all the funds sit. When a limited partnership makes an investment, they'll give the money, and in exchange for that, they get the stock certificate, and they'll hold the stock certificate until it's time to sell. So the company goes public or they get acquired, at which point they will sell that certificate, they'll take that money, and then that money gets distributed to all the investors or limited partners within the partnership. And then if you've returned all of that money, then a portion of that will also flow back to the general partnership as carry. The general partnership also has a contractual obligation with the management company. And so the limited partnership will pay management fee to the GP, and then the GP will flow that through over to the management company through that contractual obligation. Kind of to recap all of that, you have three major entities in a venture fund. You have the management company, which is the brand. You have the general partnership, which is the manager. And then you have the limited partnership, which is the actual fund. Now, the one last thing I want to mention here is that typically every time you raise a new fund, after you've deployed all of the capital from your first one, you typically will set up a new limited partnership and a new general partnership. And you do that because it allows you to bring in new investors, as well as old investors that may, not be interested in investing in your next fund can cycle out. And it allows you to bring on new general partners and new partners in the fund and get rid of underperforming ones. So that's the general structure. Now, why does this matter? Well, maybe you want to work at a venture fund. Well, you need to know, are you going to be support staff, paid salary, or are you going to be able to tap into some of the carry and be a general partner? Because those are two very different jobs. The other thing that you should be aware of is just how all of these things fit together, right? For example, you should understand limited partners, who they are, what kind of control or not they have within the organization. As an entrepreneur, you may be wondering where are you as a fund? How much of your fund have you invested, right? You may ask who are your limited partners? Because you may want to know if there's some conflicts of interest from their limited partnership. You also it's important to understand how VCs make money so that you have really good alignment with those VCs. Another thing that might be important is understanding, how many GPs there are. And is the venture capitalist that you're working with actually a GP and have that control? Sometimes entrepreneurs will work with an analyst and they'll get really excited and the analyst is all excited, but then come to find out the analyst isn't a GP, they don't have any real control, and the deal doesn't go anywhere because they weren't engaging high enough within the organization. Okay, so that's the general structure of a venture fund. In terms of the legal entities, let's talk about some of the other aspects of structure. Venture capital funds are 10-year vehicles, as we say in the industry. Now, that doesn't mean I'm driving a car, but what it means is I've got these entities pulled together for 10 years, particularly the limited partnership and the general partnership. And so during that 10 years, the first 3 to 5 is what's called an investment period. And that's where I'm going to go out and I'm going to place my bets, right? I'm going to invest in, XYZ startup companies over that time period. Now, once my bets are placed during that investment period of 3 to 5 years, then I'm done making investments in new companies, but I can still keep investing in the companies where I've already invested, right? So if I invest in an early stage company in year 1, and then in year 5, it needs more money because it's burned through all the cash I gave it and it's growing really quickly, and I don't want to lose ownership and get diluted, I can put more money into that company. But if a new super cool company comes around in year 6 and it's outside of my investment period, I can't invest in it, right? I got to raise a new fund to invest in that company. The second 5 years, or the tail end, right? The 5 to 8 years, is when you're in harvest period. And that's where hopefully you start exiting your businesses or you're selling them. I'll give you an example. We invested in a company called Spotify. You may have heard of it. When we invested, what happened was we did our due diligence on the company. We made the decision, yes, we want to invest in Spotify. We think this is a good investment. Then we called up all of our investors, all of our limited partners, and we said, hey, we're going to invest in this great company. You promised us, you committed when we raised the fund, right, that you would send us money when we needed it to make investments. So we'll collect all of a percentage of their commitments until we have the amount that we wanted to invest in Spotify. Collected all that money, and then we wired it off to the company. In exchange for that, the company then sent us a stock certificate. And that stock certificate meant that we could then sell it whenever the company was acquired or went public. Well, sure enough, a year and a half to 2 years later, Spotify did what's called a direct listing, where basically they just one day opened up shop and said, anybody that owns shares in the company can now sell them on the public markets to anyone who wants to buy them. And so when that happened, we actually sold our shares the very first day that they were trading. We had a brokerage and we called them up and we said, all right, sell our shares. And they sold those shares to investors that wanted to invest in Spotify. They then sent us that money. We took that money and we divided it out by the ownership percentage to all of our different limited partners and sent the money out. So in the first 3 to 5 years, you're placing your bets. In the second 5 to 7 years, you're harvesting your bets and maybe putting in follow-on capital. And hopefully by the end of 10 years, you've invested all the money and returned all the money plus all the profits. Now, sometimes these companies take a really long time to exit. It's not uncommon for a venture fund to have some companies in the portfolio that are still around in year 10, 11, 12, 13, 14, 15, and so on and so forth. When that happens, venture capitalists have a couple choices. Typically, they can extend the fund for 2 years, 1 year at a time. But more often than not, even if they extend and it keeps going on longer, they'll continue to manage out that portfolio company or set of portfolio companies for free, particularly if they've raised another fund. So every 3 to 5 years, you're out as a venture capitalist raising your next fund to invest. And so over time, these funds start stacking and you can generate enough fee to kind of cover ongoing operating expenses and to grow and get bigger and bigger and impact more and more companies. So to wrap it all up, key takeaway, venture capital funds are a little more complicated than just like the brand, right? You got to understand that like the fund, the brand, and the manager all form a cohesive unit that makes investment decisions. And don't forget to stay tuned to my next video where we're going to do a deeper dive into what is a limited partner and why it matters.